Every company, every organization is constantly making resource allocation decisions.
And behind each one of those decisions, Becky, is a calculation of what that move is worth. When executives evaluate a potential investment, whether it's to build a new plant, enter a new market, or acquire a company, they weigh its cost against the future cash flows they expect will spring from it. Now, to make sure they're comparing apples to apples, companies routinely discount those future cash flows to arrive at their new present value. Of course, not all companies nor all projects are sensitive to discount rate changes. In its simplest form, net present value, or NPV, is the value today of cash received at a future date, given a discount rate, which is the cost of capital. Now, most companies want to see all of the future net cash flows associated with a project discounted by an appropriate interest rate so they can determine present value of the future cash flows and compare this with other potential investments.
Roger Grabowski is managing director of Duff Phelps, as well as the co-author of Cost of Capital, now in its 3rd edition. Roger, thank you for joining us this month.
It's my pleasure to be here, Becky.
You've written and you've testified in litigation about capital assets. And as we're taping this interview in late September, everyone is talking about the capital markets. From your perspective, Roger, is this a short-term or a long-term crisis that we're facing?
It's a complicated question. There's various answers. There's pieces that are short-term, there are pieces that are long-term. We've got a short-term crisis in confidence. We have a longer-term crisis in excess assets before the market equalizes. We have excess housing, excess real estate investments that were made. Until that market surplus is used up, we're not going to return to sort of a normalized growth pattern.
Well, those recovery periods can be relatively short or they can be somewhat prolonged as the economy eats through that excess. Isn't that right, Roger?
It depends on how fast people regain their confidence. If they regain confidence rapidly, the surplus will go away rapidly. If they don't regain confidence rapidly, it'll take a long time. I've seen estimates all the way out to 2010 in terms of getting back to a normal real estate market. On the other hand, there's other kinds of companies that are doing very well in this market. It isn't just the housing market, though a lot of the economy and a lot of the press is focused on that. There are a number of companies, industrial companies, that are doing very well. But they're doing well for a very simple reason. They kept cash. In this economy, the people with cash can act and can invest and can keep their business going. Those companies that stripped themselves of cash in the last several years and didn't accumulate cash, didn't get their debt in order, they're the ones that are suffering the most. Home builders lived on debt. They're the ones, home building companies, they're the ones that are entering into bankruptcy or on the verge of bankruptcy. Many of them won't make it. Big companies, little companies who conserved cash, kept their debt levels down, knowing that eventually we're going to hit a recession. They're going to survive. They're going to come out of it faster than the other companies. And they're already. I see some of my clients are actively looking at acquisitions right now, simply because they have money, they have the ability of being able to act, and prices have come down to be attractive for companies that are good businesses. They are just overburdened with debt.
You mentioned home builders. They own property in the United States. They build homes in this country, and their customers, for the most part, are Americans. What about those companies that are exporting products or exporting services? That's a different story, isn't it?
We see right now that the world economy has grown over a period of time to be very intertwined. We also see that the companies whose earnings and cash flow have been least affected are the ones that are integrated around the world, who are not dependent on a single market. Those are the companies that are currently able to, they're still feeling the effects because the world's largest economy is slowing up. But they're the ones that will recover faster. They're the ones that will ride this storm out better. And some of them are actually prospering in this economy.
Well, you know our viewers, Roger. After all, many of them are your clients. Let's say that one of their companies follows your advice and has built up its cash reserves. They're now weighing different alternatives, building a new plant in one line of business versus acquiring a competitor in another line of business. Tell me, how do you compare one course of action with the other?
This is one of pricing. If price versus risk. Let's go through the two alternatives. If it's building a plant, expanding into a market, into a product line that I've already in, there's a great deal of understanding of that product and the demand for that product. They may be able to phase the plant in. They don't have to commit dollars today in this economy in a big buy. And that may be judicious for many companies. Acquisitions are difficult. The difficult part is not making the acquisition. If you've got money, you can always buy. In this market, it's nice because sometimes you can get what it looks like a bargain. On the other hand, is it really a bargain, or has the acquisition's underlying business suffered so much that you're getting a price appropriate for the lower business level that company is going to realize? So you have to look at the risks. The plant may not look as glamorous as an acquisition. It may be less risky because you can phase it in. On the other hand, you may be having the opportunity to acquire a line of business that may never come up again. Now, that takes care in pricing, and it takes enormous emphasis on integration. Most acquisitions fail, and in fact, one of the chapters we have in our book talk about the failure rate of mergers. The failure rate is appalling at how many and the bigger the merger, the bigger the acquisition of the acquired company compared to the acquiring company, the more risk there is that you're not going to be able to integrate. If you can't integrate, you're actually you may be overpaying. You may not think it now, but you may eventually regret that.